All right. Good morning. Welcome to our Next Level Growth. It's a monthly online educational series where domain experts share everything that they know about topics of interest to entrepreneurs and small businesses. So the webinar that we're going to do today will be trailed by another program that we launched this year called the Valley Growth Lab. That's going to be on February 9th. It's an in-person networking event where you can connect with some of our expert advisors and learn a lot of things about your business in person. So we'll give a little note at the end about how you can learn more about that. All of these programs are powered by the Valley Economic Alliance. We are a nonprofit organization focused on economic, workforce, and small business development, centralized in the San Fernando Valley. My name is Brett Dickstein. I'm an advisor with the Alliance's Business Advisor Program. So we provide no-cost assistance in virtually all areas of business development. So if you have a question, one of our consultants is likely to be able to help you find strategic answers without charging you a dime. So for more on that, you can go to thevalley.net/assistance. So today's event, it's scheduled to go through 11:30. So we've got an hour to learn about how angel investing works and how to build a pitch that might compel investors to put money into your company. This will be followed by some live Q&A to address any questions that might come up during the course of this presentation. I'd like to thank our sponsors. We've got Wells Fargo, the Small Business Administration, the SBA, and the San Fernando Valley Business Journal. We'd also like to thank Allison Turner Real Estate for providing a $100 gift certificate to one of the Valley's hottest restaurants, Anna Jack Thai. It was named by the LA Times Food Critic as perhaps the perfect LA restaurant. So you have to be present at the end to win. So stay to the end for a chance to win that prize. So let's get started. It's my pleasure to introduce a special guest. We've got Allison Byers here. Allison has a degree in psychology. Welcome, Allison. A degree in psychology from Syracuse University and an MBA from Boston University. She brings an array of fundraising experience over a 20-year career from the perspective of raising funds as well as investing. So she's been on both sides of the table. So Allison is currently an executive in residence at Merck's Digital Science Accelerator Program. She's a mentor at Techstars. She's an angel investor at Vitalize Venture Capital. She's an advisor for several startups and currently the founder and CEO of Scroobious. So in a nutshell, Scroobious, coolest name, by the way, it helps founders get investment ready. It connects them to angel investors on a proprietary online early stage investor platform. So both sides can discover one another on Scroobious. So I'd like to pass the mic over to Allison. And if you can, put all of your questions in the chat. And we'll get to those. Allison, you can decide if you want to field questions along the way or if you'd rather, just have the presentation and we'll do it at the end. So that's up to you. But without further ado, Allison Byers from Scroobious, take it away.
Awesome. Thanks, Brett. And welcome, everybody. Just quick check. Can you all see my screen okay? Thumbs up. Awesome. Thank you for the thumbs up and the nods. So I'm excited to talk to you all today. We're going to focus on angel investing. And I think just kind of housekeeping with questions. I packed a lot into this hour. I'm going to go try to run through it on time. And then we've got a good chunk of time at the end for Q&A. So if you want to type them in the chat real time so you don't forget, or you can hold on to it and then, we can talk it out live at the end. I think it's better for this one to just kind of wait, even though normally I love to do it during, but this will help keep us on time. So please, any questions along the way, throw them in there so we can make it helpful for you when we get to Q&A. So Brett gave you a really good background, but yeah, I've been, as a tech operator for a decade plus, and entered the world of entrepreneurship with my previous company where I spun a medical device startup out of MIT. I'm in the Boston area and a hospital here. And that was my first time in the driver's seat of a startup and my first time fundraising. So at that company, we raised about 10 million over the course of 5 years. We went from a friends and family through angel, through venture capital investment, and then that was ultimately acquired. And for me, what really stuck with me through that process was actually the gender bias that I encountered. I went into it eyes closed, didn't know anything about how that world worked, and it really did limit what we were able to accomplish. And I felt compelled to do something meaningful to help other founders who also identify as underrepresented know how this game works, understand how investors think, and help them create more compelling pitch material so they have a better shot at reaching the right investors for them. And that's what we're doing at Scroobious, which is the company I founded a few years ago. And I'm also, as Brett said, an angel investor myself. Very vocal on social media and online about issues of equity and fundraising and pitching and all of that. And I'm also a mom of 2 kids, and I'm very vocal about how fantastic parent entrepreneurs are. So super quick about Scroobious. In case you're interested, feel free to contact me after. This isn't a sales pitch, it's just to let you know what we do, and then we're going to jump into the meat of it. But we've basically taken what you get from working with a pitch coach and made it available on an online platform. So it's approachable, it's accessible, it's affordable, because I think everyone should have access to this type of resource. I see a couple Scroobious members in the crowd here today, actually, which is so awesome. So it's full of online learning, little tiny micro lessons that break down the entire process of pitching. You also have the opportunity to upload draft material and get feedback from a human who we train. So you get someone looking at your stuff. You can even have a Zoom coaching session. And then we have tons of curated resources and perks and a huge community of hundreds of founders. So if you want more pitch content, you can go to that website there and you get for free. Like, you don't have to put a credit card in or anything, and we'll send you a bunch of really helpful pitch stuff. Okay, so we're going to jump in. We're talking about angel investors today, and I think it makes sense to give kind of the broader context of where do angel investors lie in the scheme of other types of capital. So let's first talk about VC firms, because that's what everybody always sees out there in socials and popular press. VC has been very romanticized, venture capital, as the way to capitalize your business. Really important to understand the dynamics and their motivation, right? Each of these types of investors has different needs out of their investments. For venture, they are managing other people's money. So they have limited partners called LPs that fund them, that give them the money for their funds for them to go invest in other companies. And the idea is these general partners, the ones who are employed by the fund, are going to do a really good job and return a ton of money to their LPs by picking the good investments that generate big returns. That means for a venture fund, they cannot invest in something that doesn't have the potential to deliver multiple time returns, like really big returns. And that's because they have a portfolio approach. So they know that most of their portfolio is not going to be the big hitter, that, unicorn company that does so well. Most of them are not going to. But that means all of them have to maybe be the one that does, because only 1 or 2 are going to return that entire fund back. Most of them aren't going to be delivering profits for their limited partners. So they place a different type of emphasis on the investments they can make. They tend to have a thesis that they invest around, that they have communicated to their LPs, here's what we invest in, and they can't have too much wiggle room there because they report to other people. So it's a different dynamic when you're pitching to a fund. And they also see a ton of pitches. They see 5,000 plus pitches a year. So where those pitches come from and what they actually invest in are also different. They primarily invest from their network. So if you're interested in venture capital, that's also important to know. Most of the deals that get done are from introductions, referrals, warm introductions from other people they know. And that has a big impact. And it's just good to know these statistics so that you know what you're getting into. And the other side of this, and this is my space, I'm very vocal about it. People, should know this so that you know what you're getting into. Again, I didn't know it at my last company, and I'm very glad I do now. the funding numbers that come out for venture capital, which is only one type of capital of a whole bunch of them, don't tend to write checks to underrepresented founders. So it could be your gender, your race. It could also be other factors like your geography, or if you're a veteran, lots of other things to consider in there. But we tend to top out at about 2% of VC capital allocation. And this isn't that surprising when you see that most of the general partners, the ones making the decisions, are men, and are in particular white men. And they source primarily from their own network, and you tend to know other people who are like you. So when you understand those dynamics, none of it is okay, but you can see how this is happening. So just something to know. So if you do think venture funding is the right path for you, there are some things that you can do. You start early. So one is network your way into CEOs of portfolio companies. So other companies that fund has invested in, get to know those people. And if you can develop a relationship there, they might make you the warm introduction. And that's a great warm introduction to have to a fund, is from someone they have already funded. So you can start working your network. And then you also want to research all the general partners at the fund. Don't just get to know one of them, because a fund is an employer and people do change jobs and leave and do other things. And you want to have a sense of everyone who's working there, so you really understand the people and the culture, and who else is on the team. And then if you do end up with meetings with venture capitalists, and this is the last slide on VC, then we're not going to talk about it anymore. We're moving on. So if you do get meetings with venture capitalists, go into it with your goal being to get more time. And we're going to talk more about that too. But there is this misconception with a lot of entrepreneurs that when they enter a pitch meeting, and this stands for VC or otherwise actually, but your goal should not be to get that person to write you a check, because that happens over time. That's multiple meetings and relationship building. It doesn't happen after a single meeting. So set your expectation and your ambition for, I'm going to get another meeting. That's my goal. And you'll have a much more effective pitch and meeting in that case. And then get really active on socials, especially Twitter and LinkedIn. Investors and founders are all over the place on those platforms. And so you want to start understanding, building up your own brand voice, but also seeing what other people are doing out there for thought leadership and the material they're putting out. You can engage with a lot of these investors on socials and build a rapport that way, and then start talking to them live. But it's a really good thing to do if you think you're going to play in this world, so that you understand what's going on in it. Okay, I'm going to move on from VC. Now we're going to talk about angels. So angel investors is a different type of capital source with different needs out of why they invest. And they are a much more appropriate source for early stage founders. Apologies if you hear my dog. I've locked him out of my office, but he is very loud. So I'm sorry if you hear that. So in the US alone, there are more than 4 million actively investing angels. And that is an undercount, because angels don't have to disclose their private investments. So it's actually pretty hard to get information on them that's accurate. But you just have to be accredited. You have to be an accredited investor. So there's rules that the SEC puts out that says you can't invest unless you meet certain criteria. And then of all those millions of people, We know of 4 million that are actively investing, and that is a lot of people. In particular, it's really neat that there is a new rise of emerging angels. So I'm considered an emerging angel, somebody who has recently gotten into angel investing in the past year or two. And 3,000 people will make their first investment this year. That's a lot of people. That's a lot of capital. It's just dispersed because it's individuals. And that's the other neat thing about angels is they're just managing their own money. It's not someone else's money. They don't have limited partners. Their fiduciary responsibility, so who they need to be working toward, to return toward, is not anyone else. It's them. And they invest for whatever reason they want to. Oftentimes, it's less about the return size, which is what's most important for a GP, for a fund, because they have pressure to return to their limited partners. Just an individual, they might consider it a win if they don't lose money, right? They want to get into it for different reasons, different motivations. Often they have some operational expertise, or they have passions for things that they want to be able to help fund and help support different types of entrepreneurs they feel a connection to. And that's a very different type of relationship building and motivation for funding something. So this is very personal. It's developing a one-on-one relationship. They see fewer pitches than a fund does, although there are people called super angels, or people whose whole career is angel investing, and they're very vocal and prominent in the community. They have higher deal flow or more pitches coming their way, but they're the ones making the decision. Now, angel investors can also be part of an angel group. So this is where, if you're an angel investor and you want to get more deal flow, like you're not seeing enough, or maybe you want to learn how to best practices for how to invest, or how to do what's called due diligence. So diligencing a company to figure out, is this the investment that's right for me? You can join a group. Groups tend to be regional. They usually focus on an area, or they could be alumni of a university that come together. They could be alumni of a company that hit it big and generated wealth for employees, and now they're in a group together. It could be around an affinity. There's a number of reasons why people would come together in a group. But when you pitch an angel group, it is different than pitching a person, an individual angel, because a group needs to have more of a process. And so it operates a little bit more like if you were pitching a fund, because they have intake forms and they have, pitch events and people that are operating the group that help make decisions about what the group might want to see. And every group is different and has different things that they look for. So an angel can be part of a group and they can invest on their own. They're not mutually exclusive. But that's just kind of a key difference, again, in understanding how do these, things, how do people operate? How do they make decisions? A group is different than an individual. All right, so the rise of the emerging angel investor, where the VC one looked a little dour, the angel is really promising. And this is why it's such a great capital source to understand. If you're funding your small business, or even if you're doing a scalable tech company, there can be really great assets and a much better use of your time to find that funding. So angels as a whole invest 25 billion cumulatively in private companies in a year. And that's an undercount, again, because a lot of these investments are not publicly reported. If you're not a fund, you're not regulated. An angel doesn't have to report their investments in the way that a fund does. But that's a lot of money that's going into direct investments. They are much more diverse. Angels are 30% women, and they look to support other women, which is great, because I can share, in my home state of Massachusetts, women got 0.9% of the venture capital dollars that were distributed here. Angels have a much better share. They are 63% outside of major geographic hubs. and they tend to be younger. They tend to really care about funding initiatives that they are passionate about, funding founders that are not traditionally funded, and they're out there looking to meet new people, broaden their network, and really get more into angel investing. So, how do you find angels? There are some directories of angel groups. You can go on a site called Angel List, or there's others where there are some active angels. But I encourage you to broaden your view of who might be an angel, because there isn't this big directory of all of them, and they aren't registered entities or companies like funds are. You actually don't know who angel invests. So the first thing that I would encourage you to do is think to yourself, what type of person, if I described what I do, would just get it? They would just understand what I'm doing. They would totally see the vision. I wouldn't have to convince them that this is a good idea. Who would just get it and relate to what I'm doing? What kind of demographics, work history, psychographics, location? Think through that persona of who would just like naturally see it and get excited. You don't have to think of a specific person, just what type of person. And then you're going to do some searching for that type of person. It doesn't have to be someone in your network right now. Using LinkedIn is a great way to search your extended network for that type of person, right? Think about what stage of their career would they be in? Are they, a mid to senior level executive in some type of organization in an industry? Try to find a list of people, make a list of people that fit that description you think. Then you're going to craft some emails, and it's fine if they're what's called cold emails, so you don't already know this person. But the important thing is to really personalize it. It is worth the time. So you start it with, I saw you said this on this platform, or you were quoted saying this, or your company just did this initiative, really spoke to me. I think, you would have some amazing advice or guidance for what I'm working on. And again, personalize it with the reason why them specifically, not generic language. It has to be showing that you found something they said or did that spoke to you. And then ask if they'd be willing to have a 20-minute phone call with you so you can talk about what you're doing and get their valuable advice, right? You're starting a relationship. It's not a sale. You don't want to approach it like a sales call. You're building a rapport and you're getting to know somebody. And so you go into that call really wanting genuinely to hear their advice, because if they're that user persona that you've developed, they should have some good insight into what you're doing. And so value the call for what it is. Then you continue developing that relationship over another 2-3 calls, and you can ask if they angel invest. They might, very likely, and they might be interested. And if they're not, okay, you've made a really valuable contact in the space, and you can ask them if they know anyone who might be interested or who might angel invest. And you're likely to start building up a really strong network with that approach. So 2 other sources of capital I just want to throw out here to make you aware of. One are family offices. So these are a little bit different. They do direct investing activity, but they're managing a generational wealth of a family. So they run like a fund, but they're not usually managing other people's money. And so it's a little bit in the middle of a fund and an angel, where it is still about the relationship building, but they're looking to invest in things where they have the family experience or expertise in the industry that generated their wealth. They have a generational view of their investments versus kind of a portfolio view that needs a return in the next 5 to 7 years. So just to make you aware that that's out there too. And they typically have the cash on the books. So it means they don't have to go out and raise a fund like a venture fund would have to, because they're managing the wealth of the family. And then the other one that's gaining a lot of ground is crowdfunding. And maybe some of you have heard of crowdfunding. There's different types of crowdfunding. and one in particular is equity crowdfunding. So this is a platform or a website like Republic or WeFunder, Seed Invest, iFund Women. There's a bunch of them out there. They are regulated by the SEC to be able to affect investments. And what's neat is you don't have to be accredited to do a crowdfunding investment. So it opens up investing to a whole lot of people. This tends to work well if you have a strong community support or customer base where you can bring them in and say, you want to see what we're doing out there and growing, you can be part of it. You can help support us and you can share in the wealth that we're going to generate because you'll have equity in the company. So this can be a good option for people, but it also comes with a lot of regulations that you have to abide by. So you also want to do your research. Every one of these operates differently and has different requirements. And you basically are running a marketing campaign versus pitching a lot of investors. So you have to get accepted onto one of these sites, and then you build your profile page where people can do the investment. And then you have to market it, market, and let people know that it's there. So instead of going and pitching investors, you're constantly putting the word out about this campaign and trying to direct people to your page, to your website, because that's the only place you can talk about the investment since it's regulated to happen there. Okay. So I've got a back half of this presentation that talks all about pitching. I know we said save questions for the end, but I actually might pause here. Does anyone have any questions about these different types of investors or anything that we've covered so far?
Let's see if there are any in the chat. Nothing in the chat yet, but I will say, with this brief interlude, we've got a motley crew of participants from various industries. They're really from all walks. We've got folks on this webinar from media and entertainment, consumer packaged goods, blockchain technology, software as a service, online marketplaces, HR, finance, arts, culinary arts, travel, hospitality, fashion, and even some stealth mode startups. So that is a mouthful. But are there investors for everyone? And where should our participants kind of start to source a pipeline of folks that might, want to be a strategic investor in one of these types of industries or sectors?
Yeah, so I mean, it doesn't matter your industry. You might be appropriate for any one of these capital sources. There are different industries to consider for different things. So the big one is if you are a service-based industry, it is a little tougher to seek equity investment because it doesn't necessarily scale easily. Now, there are really big companies that are service-based that do, great, that are household names. So it doesn't mean you don't have the ability to scale. But if you're seeking venture capital, they really don't like service-based business because they operate on growth metrics. They need you to grow really fast. And it's harder to do that when there's the human element, when there's service. So that's one thing to consider. If you're service-based, you might want to think about some of these other avenues. Something else that I didn't put on here, there is another type of funding called revenue-based financing. And if you are generating revenue repeatedly and you can project that out, you can get financing that, again, is a little bit of an in-between of some of these, where they'll give you the investment you're looking for, and then you repay it as a % of your revenue over time, and there's no equity given. So you keep all your equity and you get the working capital. It's a little more expensive because there's an interest rate when you pay it back, and it's coming out of your bottom line every month, but it usually adjusts so it's a % of revenue. So it's not going to take all of your revenue. So if you fluctuate, it's okay. But that might be a good option if you are a revenue generating company and you need some cash right now, and then you don't have to give away or go through the whole pitching process.
Now, 2 questions came up as you were chatting. And the revenue-based financing is definitely a solid alternative if you've got some cash flow going. The questions are, essentially very similar, but one of the participants has a consumer packaged good company, and looking to figure out where would I find any kind of angel investor database to kind of source someone that would be interested in that. And then another participant said that they've got a capital intensive business. It's regional air mobility, and they're looking for a family office to explore. So I think the question resonates similar to my first one is, where is Scroobious the database? Is that the marketplace? Is that one alternative that people could go and, they say, I need funding. Where do I get a check? How do I pitch investors? Where do I go? Where do I start?
Yeah, no, it's a great question. And it honestly is a reason why I am building a marketplace, because there isn't one central marketplace right now. It isn't easy to necessarily find someone who aligns in the way that we're talking about. So we're building one. We also do have a bunch of lists of investors that we have curated, and we have, pretty extensive networks, so we can help in the meantime before we've launched our own marketplace here. But that's what I would do. I would, there's lists floating all over the place. You can go to the Angel Capital Association, and they have a list of all the groups. So that's a national association. I'm on a DEI task force there, and you can see their member groups, and you can check them all out, see what might be a good fit for you. A lot of those groups also have intake forms that you can find on application platforms. So like F6S.com is a platform that a lot of accelerators and angel groups use, and you can search for different potential opportunities there. But honestly, with the if you're a CPG company, one, you might want to think about accelerators. There are CPG specific accelerators, and two, I would still do that exercise of, regardless of hunting through lists, or, you can look at Angel List. There's tons of different syndicates there. You don't really search for people, you search for syndicates, which is one angel who has, who gets a lot of deal flow and invites other angels to participate in deals that they're going to participate in. So I'm part of a few syndicates. There's, thousands of them. I encourage you to think through that profile still. Who would just get it? It's worth the time. And you can try to find that person versus look through every list you can find and just try to write as many emails as possible, right? You can do it that way, but just if if you're in B2B sales and you're doing that too, you're making your customer persona and you're trying to find who would be a good fit for you, who would be an easier sale because they would get it and they have a need. You can think that way with angels too. So not the most satisfying answer, but there are more angels than you think, and you can also leverage any networks that you have. Think back to where you went to school and search through alumni. You already have something in common there, right? You're alums, and there's a lot of alums who are now investing. You can think through if you're part of any associations, like trade associations, or if you're part of tech networks or online, networking systems. Ask around. If you haven't asked about angel investing before, see if you can find some who already are in your networks.
All right. So I think there was a question, but I think I'll let you get to your presentation because it'll probably be answered in the presentation. But somebody asked about, how do you protect intellectual property and confidentiality, especially if there's like a new concept you're introducing with the idea of fundraising, and kind of how much of the beans do you spill, so to speak, right? So maybe you'll get to that along the way. And people are very interested in Scroobious's marketplace for connecting founders with investors. So I'll let you get to that whenever you're ready to.
Oh, great. Yeah, I'm happy to answer questions about that and what we do and how it works. We're a startup too, right? I'm in a very meta position. I'm in a similar boat to the founders that we work with. But in terms of your IP, my general advice here is no one's really looking to steal your idea. Founders get very guarded about it, but honestly, it's all about the execution. Even if someone thinks you have a good idea and they want to go do it also, they're not going to come at it the same way that you would. They probably aren't going to have the energy, right? You're doing this because you care about your business and you have some expertise or background or something that fires you up to do what you're doing. Someone who's copying someone else's idea doesn't have that in them naturally. And they're not going to execute it the way that you do. And also, people just aren't looking to steal. Honestly, they don't care as much as you think they do. It sounds bad, but they don't. And if you're out there trying to build your business and get, the word out that you're doing it, get funds in, you should be telling everyone about it. Right. The time where it matters with an IP fence is if you do have, patents that you're going for, or if you're in a very scientific field. And, I ran a med device company. We had a patent, went through FDA. I understand the building of an IP fence. So don't share trade secrets in your, in your initial meetings. Don't, if you have patents, get it out there that it's patent protected or patent pending. But when you're pitching an investor, one thing you should not do is ask them to sign a non-disclosure agreement or an NDA. It's actually kind of a red flag if you ask, because investors just won't do it. There's a number of reasons. We run our own expert workshops. We just put out content. Actually, if you go to our website in our last newsletter, one of our sponsors is a law firm who just wrote a whole article about non-disclosure agreements. That's in you can go to our website and go to updates, and it's the most recent. It's January's update. There's a whole link to an article in there about NDAs and when it's appropriate and not. But in general, don't worry about it so much. Okay, so I'm going to get into the pitching part of this. So this advice holds for whether you're pitching to get into an accelerator, if you're pitching an angel, if you're pitching venture. This advice that I'm going to give you right now holds for all of them. So it's a super condensed version of what's in our platform, but it's high level to fit in the remaining kind of 20 minutes that we have here. So when you think about pitching your opportunity for investment, there's two lenses to look through. One is storytelling. You have to tell the story of how someone's going to make more money later than they give you today. That's a different story than selling. Selling is more natural than pitching for investment. And you really do need it to be in a narrative, in a story format. And then with that story, really what you're doing is removing risk that it's going to work. Because any investment is a risk. No one can predict the future. And that's what the investor is doing as you're pitching. They have their own appetite for how risky something can be for them to put their money behind. And they're trying to mitigate or remove risk as you're telling the story. So that's a side of it that founders don't often think about, but that's what investors are thinking about. They approach it from a risk assessment. So whatever information you're giving should be mitigating risk that it's going to work. So when it comes to the story, there are tons of pitching frameworks out there. Part of the really frustrating part of pitching is that there's no authority, there's no one right way to do it. That's really frustrating. We have a framework at Scroobious. This is based on hundreds of investor interviews, tons of secondary research. It is a narrative that tends to work well for most investors, but at the very least, these are the core sections of information that you need to address in your pitch. They could be in a different order. It has to feel natural and right for you, but you need to cover these basics of your business in a pitch. So again, it's very different than selling to a customer. The investor might never be a customer, but they might really see the opportunity for the investment in you and your company. And those are very different things. So when we look at these core 10 sections, and this is what, in our platform, we go deep into every one. I'm just going to talk through the 10 here, the way that we have it now for today. But the first thing you start with is your mission, which really is your origin story. This is where you talk about why you decided to start your company. And I'm going to get, the next slide is all about the risks. But you need to communicate you as founder. Why are you doing this? because if you're early stage in your company or you're a small business, you are the one making the decisions of how to use that money that you're asking for. You're the steward of the capital. So you have to be clear that you're in this for the right reasons, right? The investor has to believe that you are in this for more than just the potential of financial gain, that there's good reason for you to be doing this. Then when we understand your decision as founder and you, we have to understand the problem you're addressing. What is out there that is a pain point for a group of people, right? I have to believe, independent of what your solution is to the problem, what exists today that people need a solution for. They're experiencing an acute pain, and a lot of them are, right? It could be it could be people, it could be companies. You're basically describing your potential customer and convincing the investor there are a lot of them and they are feeling pain in some way from this problem, so that they're going to want to address that pain. After that, you're going to talk about your solution. How do you directly solve the problem you told me about? So it has to directly link to it. Don't tell me about a solution that solves a slightly different problem, right? They have to be tied together. Those three things are critical. They're the most important. It's why they go right at the top of your pitch. Even when you're doing just networking kind of pitch and talking about it right away, I have to understand why you're doing it. I have to believe there's a problem, and I have to believe you can solve that problem. And if I don't buy into those three things, I don't really care about the rest of the pitch, because the rest of it is execution and business mechanics. That's why those three are right at the top. They are the buy-in, the tickets to the game. Once we buy in, okay, so now I understand what you're building. How are you going to make money with it? That's important. I have to understand your business model, because you're pitching me to invest. So I have to know that you understand how to generate revenue. Even if you're not generating right now, you could be pre-revenue. I have to understand how you think you're going to generate that revenue. What's the major driver here? And do I believe that your customers would pay based on that model that you're implementing? Then I need to understand, how much money could you make? How big is this market size? And so I actually do a whole other workshop just on market sizing, because it is really a challenge area for a lot of people. But this is where you talk about your TAM, your SAM, and your SOM, your total addressable market, your serviceable addressable market, and your serviceable obtainable market. I know those things might be foreign terms or confusing, but they're really important. We have lots of content about it. Let me know if you need more market sizing. But the reason it's so important is it can determine if you are investable for someone or not. Whether it's, so venture has benchmarks. You have to have a TAM, a total addressable market, of at least $1 billion to make it investable for a venture fund. Angels don't need it to be that big. They have different needs of what the return they could get is. So their definition of something being investable is different. If you're applying for a loan or for debt, they also need to understand your revenue potential, not just how you're making revenue, your business model, but how much of it you could make. But again, they don't need venture returns. So there's different, goals for what it needs to be, but you do have to know what it is and figure that out. Then you want to talk about your competitive landscape. Huge red flag if you say you don't have competition. Please don't do that. Everyone has competition. And competition is good. It validates that there is a need for what you're doing. It's good if other people are also trying to solve it. If truly no one is trying to do what you're doing, maybe you don't need to be doing it. Maybe there's not a real problem that you're addressing. Then you want to talk about why now. First, why is now the right time for your company to exist? Why is now the time to be doing what you're doing? And then why is now the time for you to be fundraising? And that's all about your traction. So you have to tell the story about why it's the right time for what you're doing, and also that you understand that now is the time in the chronology of your company to be raising funds for what you're doing now. Then you're going to talk about how you're going to go to market, which really means how are you going to acquire customers? This is your customer acquisition strategy. And this is where you're showing that you have what's called founder market fit, that you understand your market so you know where to reach them and how to convert them. And then your team. So your team can either go at the front of your presentation or at the end. It tends to work really well to bookend a pitch with people. So you start with your origin story, why founder you decided to start your company, what the mission is, and then you end with, here's the team I've recruited that are going to help me execute all the things I just told you about. So the team is more about doing the thing and less about the heart or the mission behind it. And then thank you, a thank you slide. I put it in here because it is wasted so frequently. This hangs around on the screen a lot. You can put stuff on it. Don't just have a big thing that says thank you. Put all your contact information. You can ask for stuff that isn't money. You can ask for stuff that is connections you're looking to make, or introductions, or whatever it is. Put stuff on there, because if you're sending a pitch deck, it's going to hopefully get passed around within a network if you get somebody interested. Okay. Flip side, the risks. So we went through every section. This one's going to go faster. With your mission, the risk is that an investor knows it's going to be way harder to build your business than you think it's going to be. So when it gets that hard, there's a risk that you might walk away from it, or you might just kind of check out and start making bad decisions. That's why we have to know that you're in it for more than just potential financial gain, because that's not a strong enough motivator to stick with it when it gets really hard. Problem, the risk is that there isn't a true problem to solve, that it's not really a big acute problem. Solution, the risk is that you don't actually solve the problem you told me about, or it doesn't seem realistic that you could do this, that you could build your solution and make it work. Your business model, there's a risk if it isn't clear, or it doesn't seem feasible, or it doesn't seem like the right model for what you're doing, because there's a ton of models out there, right? You could be SaaS, you could be subscription if you're a tech company, you could be service or fee-based, you could be a razor blade model. There's all kinds of models. So there's a risk that you have a mismatch in your revenue generator and your product or your customer. Market size, the risk is what we just talked about. It doesn't support an investment. It's not investable because it's not a big enough market. Competition, the risk is if you say there isn't any competition, that's a risk. The risk is that you aren't differentiated enough, that you have a crowded market and it's not clear why someone would pick you over other options. With Why Now, the risk is that the timing of either your company or your fundraise are going to hinder your success, that it's not actually the right time, and you have factors working against you in the adoption of what you're doing. Go to market, the risk is that you don't understand how to reach your customers. So you can kind of see as you're telling your story, the content you put in these sections should be reducing the risk of these things. And then your team, the risk is that you don't have the right people to execute on everything you just said. And your thank you, there's a risk that you don't have a presence, that you don't have thought leadership. That's why you give someone all the ways they can reach you or find you on the internet. Everyone should have a presence of some kind, right? If somebody tries to find you and you have no socials, and if I Google your company name or your name, nothing comes up, there's a risk there that you're not a thought leader in your space. Okay, so I'm going to give you just some more top tips. I'm going to go through real quick. We've got about 10 minutes here. So as you think about your slides, this also goes for any presentation you give. I cannot stress this enough. The people in Scroobious that are here are probably sick of me saying this, but use header statements on your slides. It changes the whole presentation. So when we talk about labels, this is where you see things like problem, solution, team, and there's just a label at the top of every slide. That's not giving me any information. And your goal with your slides should be to have somebody be able to look at it and get the point as quick as possible. An investor on average spends 3 minutes looking at a deck. That's average, right? So half the time it's less than that. You need them to get the point fast. Don't make them work for it. So every slide should have one major point to it. If someone remembered one thing from your slide, what do you want it to be? You get to dictate that. Write it up there at the top. It's okay if it's 2 lines. All the examples, I don't have a ton of examples in our deck for today, but I only use real examples. So here, instead of just problem, what if the top of the slide said benefits are expensive and undervalued, so employers need to increase their cash pay to compete? That is a statement. That is the point of the slide. And then everything else on that slide convinces me that's true. That's where you bring in a data point, something that convinces me that statement you just made is true. Same, so another example here, instead of just solution, it said, what if it says, our hardware is paired with a mobile app to increase utility and adoption? Boom, statement. And if you have that on every slide, you are walking someone through a story. This works for sales decks. It works for academic presentations, makes it so much easier for your audience. Saying how we get there or how we win, those are labels. Tell me the how. That's the statement. Okay, and then your timing of your pitch and different formats of your pitch, because we get asked this all the time. Some of you might have demo days you're participating in or shorter form pitches. I talked a little bit about this already, but instead of like number of slides that you need, think about how much time you have and what the goal of the pitch is. So a good rule of thumb is you should have presentation material that is about 1/3 the length of the time of your meeting. So if you have a 30-minute meeting with an investor, plan to have about 10 minutes of material that you're presenting. So you leave 20 minutes for discussion and question and answers and rapport building. That's the good stuff. If you show up to a 30-minute meeting with a 30-minute presentation, it's not going to go well. So think about it that way. You might, have 5 slides for 10 minutes. You might get through 15 slides in 10 minutes. People have different speaking tones and different paces. Figure out what you can do in that amount of time. And then your goal is almost always to get another meeting or to get more time. Like I've said before, it's almost never to just get a check. So think about what is it that you need to convey to convince someone that you're worth another meeting, not that you're worth a check, that you're worth more of their time. So think about it that way rather than I need 5 slides and it has to say these things, right? What do you need to achieve your goal? So if you have less time, what if you only have 3 minutes to do a pitch? You don't have a half an hour. Cut out some sections that you don't need to convince someone you are worth more time, right? So in this case, we still need to know who you are and why you care about what you're doing, the problem that exists, how you're going to solve it. Those are always things we need to know. But if you have 3 minutes, you can also get in there. Well, how are you going to make money with it? And do you have any traction? What are some signs that people want this? What have you done for progress? So think about it in that way. Then what if you only have 1 minute? What if it's an elevator pitch and you're just networking with people at a conference and you've only got a minute? Okay, again, think about what is compelling enough to achieve the goal of having someone want to talk to you more or come up to you after you've finished your minute, right? That's your new goal. What do you have to tell someone? Again, we have to know who you are and why do you care? What is the problem? How are you solving it? And traction if you have it, right? That's probably the next most important thing to convince someone you're worth more time. Okay, and then how to handle feedback. We get asked this question all the time because this is another big pain point, no matter who you're pitching, if it's angels, if it's venture, if it's, whoever. Investors love to give you feedback. And because there is no one right way to pitch, you will get totally conflicting feedback from different people. And those people will be equally important to each other. So my best advice with feedback is to fight the urge to make a knee-jerk reaction and change everything based on what one person says. You're going to want to. If you pitch someone who you really like, they are important, you respect them, you want, to be in their favor, you want to work with them, you're going to want to take all their feedback and go do it right away. But then the problem is you're going to pitch the next person who you equally want to work with. They're going to tell you a bunch of things that you might want to consider changing. And you're going to say, oh my God, I had a slide that did exactly that. And I just changed it. I wish you'd seen that last version. And you're going to drive yourself crazy. So get at least 4 to 5 different people's feedback before you make a change. Look for patterns, look for where people are asking you the same question over and over again. Let it soak in a little bit, give it some time, because at the end of the day, it's your opportunity that you are inviting someone to participate in. It's not theirs, and they're not better than you, and they don't know your business as well as you do, no matter how impressive they are. You're offering someone the ability to profit off of what you're building by giving you money now that you are going to turn into more money later. So it has to feel natural and authentic to you. That's why you need multiple pieces of feedback to decide if you really do want to change things up. Okay, couple parting thoughts, then I'm going to stop talking. So one is confidence matters so much. It's how I raised a lot of money at my last company. I'm a strong presenter, but I am also confident when I'm speaking, and there are signals you can give off to exude that confidence. And it matters because people make these decisions, and we are all the same brain structure, right? We're emotional, we react to things, we don't realize what we're interpreting all the time. We are not rational decision makers. Confidence is overweighted in investment decisions, and it goes back to them trusting you to make decisions with their money. They want to know that you're a confident decision maker. So if you dig deep, a big part of confidence and displaying it comes from understanding that you're equal to whoever it is you're talking to. A lot of the times founders put ourselves in kind of a lesser position than investors, or we think investors know better than us. And particularly for women or minority founders, we do tend to really do this. And we act like we couldn't know as much as the other side of the table. And it's not true. And that does you a disservice because you don't act as confident or display confidence in the same way. So hold on to that and just recognize, like I said in the last slide, investors don't make money if they don't invest in things, and they're investing off of the work that you're doing. So you're bringing them an opportunity, and you should look at it that way. And so other little things like don't break eye contact. We tend to look down a lot when we're pitching, particularly women. We kind of look down when we're talking and then we look up. Confidence comes from eye contact. Like our brains receive it as confident. Make eye contact. Short tones, speak in statements, just like you're going to put at the top of your slides. Train yourself to display these signals of confidence. Gary's laughing. I don't know if he's laughing at me or not, but it's good advice. Maybe you're already really confident. You're like, I do that. Okay. So this is also a funny slide. This is my last one. The other part of confidence is from practice and practicing out loud. There is no substitute. Even if you're not presenting slides, even if it's just conversational pitching or fundraising or whatever it is, if you don't say the words out loud to yourself, you don't hear it the same way, and you don't have the ability to speak as confidently when you're with other people. So I cannot stress it enough. No matter what kind of presentation you're giving, say it out loud, whatever you need to do. The other great practice, I know it sounds silly and maybe like you're like, I can't do that. It's one of the best things you can possibly do. Explain what you do to someone who is not involved in your professional space. Grandparents are great for this. Kids are great for this. explain what you do, and ask them to tell it back to you. So explain it and then say, hey, can you just tell me in your own words what it is that I do? They are synthesizing what you say in their heads as you're talking, and they'll give it back to you in simpler language. Like they're doing work for you. And if they can't tell you what you do, or if they say something that is not correct, you know you have more work to do to explain it. Because investors do tend to be generalists. They don't tend to have super deep expertise in what you're building or what you're doing. And you have to be able to describe it in a way that anybody can understand. And I can tell you, we work with biotech, hard tech, we've worked with hundreds of founders. I don't care how complicated it is, you can do this. And testing it out with other people is a great way to do it. And then the other things here that I've already talked about a little bit, but for confidence, eye contact, train yourself to look in your webcam if it's virtual. You feel my eye contact. It's been shown in studies the same way you would in person. If I look at your faces, you don't. I'm not making eye contact with you. I am when I look in my camera. Train yourself to do that. And train yourself to get rid of filler words. Everyone has a filler word that you go to. Could be well, like, or train yourself to get those out of there. You sound much more confident when you don't have them. Okay, I'm all done. I'm going to stop 2:05. I'm right on time.
All right.
So
Awesome.
There you go. And there's all my contact information. So feel free to reach out at any time.
Super. Very knowledgeable, really packed a lot of information in there. So everybody, you can reach out to Allison after this. If you've got specific questions or you want to talk to her, work with her, feel free. Now we're just going to take about 15 or so minutes, and we're going to have some Q&A. So I do have a few questions right off the bat, and I consolidated them. So should the pitch deck, Allison, should it include a few things? Should it include the ask amount, the use of funds? Should it include a valuation? Should it talk about the ROI for investors? So, those 4 things, should they be in there? Valuation, ROI, ask, use of funds.
Yeah, those are great questions. And so there are some sections that are not in our core 10 that when we do like a full pitch workshop or, on the platform, we talk about these, we have them as optional for pretty specific reasons. And those things are in there, right? So your financial projections, you need to make those and you need to have a slide for them. They don't need to be in your core deck, because for your first meeting with someone, when your goal is convince them I'm worth more time, I'm worth another meeting, you don't need your projections to convince someone of that. Unless you're a more mature company and you're later stage and you have a lot of historical sales data, then maybe you would want to include it. But if you're early stage, you're really kind of making it up, right? Everyone's making up projections. Everyone knows that. You don't need that to convince someone you're worth more of their time. But you do need to make the slide, because if you get more of their time, that will come up in your second, third, fourth meeting. And it will be in what's called your due diligence. So when you're pitching, sometimes angels want to do due diligence, sometimes they don't. An angel group always will. A fund always will. That means when they are really interested in making an investment, they want access to a bunch of your files, your financials. They want to vet you. They want to do their diligence and make sure that you're saying things that are true, so that they make a good decision. So your financials will be in there.
Do they have more of the leverage when it comes to, like, if they're really interested, they start their due diligence? Are they coming to the startup or the small business owner, the entrepreneur, and saying, we're going to do the valuation on you. This is what the ROI we expect after looking at all the numbers. Is that kind of, yeah.
Yeah, well, so valuation is a different thing. So this relates more to your ask and the money that you're asking for, right? You also do have to have an ask slide. I don't have it in our model in the core 10 because there is a rule from the SEC called general solicitation, and they care about this rule. I did a big review with my counsel when I founded Scroobious to understand what does SEC care about in fundraising. So you cannot show an ask slide where you have, I'm raising this amount, at this, for this named raise using this vehicle. You can't show that to someone who isn't accredited or regulated to make investment. Otherwise, you are soliciting the general public, and you can't do that because non-accredited people can't invest. So that's why it's not in the core 10. It just introduces a point of decision, a little bit of friction for you to say, yes, this person is accredited or they're regulated. I'm going to move my ask slide in, present it, and then get it back out of there. So you're always making that decision. So don't put that up on a platform or social media where you don't know the audience looking at it. With your valuation, that depends on the stage of your company. So if you're raising something called a SAFE or a convertible note, or something that's actually a debt vehicle, because you're not giving someone equity right now, you don't need a valuation. A formal valuation, it's called a 409A, but that's where if you are actually exchanging equity for money, so a priced round, then you need to have some way to value every share. So you know what they cost. So you know how many shares to give someone in exchange for their money they're giving you. But if you are using a note or a safe, you're not doing that yet. So they don't actually get equity right now. So you don't have to price the shares. What you do instead is you usually have some kind of a cap, a valuation cap. So it's saying, when my company does a priced round and your note or your safe converts into equity at that time, because we will know how much every share is cost, every share is worth, we're going to make it so you, because you're taking a bet on me now, wouldn't have to pay more than this amount by capping the valuation for you. So sometimes people call that a valuation, but really its function is different than actually having a price per share.
Okay, that's great answer. I think that answered very well. I have a question for you. You mentioned traction as you're talking about the pitch deck. So what does it really mean to have traction? Why is that so important before considering pitching to investors? And is it just like having a minimum viable product, having a prototype, having a demo? Is that enough? What's traction?
Yeah, so it's a great question. Traction can come in different forms, but at the end of the day, it's a very important de-risking element, right? It always comes down to risk. So traction is different than product development. Traction is more about the market saying they want what you're doing. So it could be sales. It could be we've brought on this number of customers, or we have this many users who are paying for what we're doing. It could be pre-sales, right? It could be we have a wait list of 1,000 people, or sometimes Kickstarter is kind of used as traction because you're selling something before you actually make it, right? You're getting funds to make the thing. You're showing with traction or progress signals from your customer base that they will or are buy what you're selling. So having an MVP or a prototype or early versions of your product is great, right? So I can tell you, like for me, my very first product was just a Google Doc. I put all my guidance, the content I created into a Google Doc to test, is this what will this help a founder the way I think it will? And we got someone into Mass Challenge with very little lift, mostly their self-learning on the content. That was my traction, not the Google Doc, the fact that it worked. Someone used it and followed it and saw a success mark. So that's what we mean by traction. The investor's trying to figure out, will people buy this, right? What have you done to de-risk that part of it?
Yeah, that's great feedback, because you can't go too early to an investor. They're just going to say, come back, in a year when you have some traction, or you've demonstrating something that's going to move the needle. So, speaking of Kickstarter, if you go to those equity crowdfunding platforms that you were introducing, like WeFunder or Start Engine, you can go and find a ton of campaigns that businesses, many like yourselves, are pitching. They've got their deck on there. It's all, very public. You can go and just kind of play around and see who's out there and there's a lot of interaction between the investors, right? There's a ton of questions, and it's all sort of public, and you can kind of follow what's going on. So with all these, equity crowdfunding platforms gaining a lot of interest as a place where angels are going to invest, it kind of begs the question, what is the right timing for someone to say, hey, I'm ready for equity crowdfunding? Do you have to have a certain minimum cash flow every month, like monthly recurring revenue? Or when do you go to, those platforms when you really think you can move the needle? And on the other hand, if you do move the needle and you get a lot of interest, are you going to have 1,000 investors on your cap table that you have to now appeal to and reason with and satisfy?
Yeah, also great questions. So first, I'm going to break it down into a few things that I heard you say. First, with crowdfunding, yeah, you can go to a crowdfunding site and see anyone's pitch, their ask, how much they're raising. It's all public. That's because they're regulated. SEC regulates all of those crowdfunding sites. And if you run a crowdfunding campaign, all you can say publicly is go to my page. You can't even say how much you're raising. You just say go to my page, because that's the regulated piece of it. That's how you're not soliciting the general public. So that's one thing with crowdfunding. In terms of when do you do a crowdfund, again, it's more about, do you believe that you can get a lot of people to contribute to that campaign? So you can be different stages, and there are different crowdfunding portals for different stages of companies. There's growth crowdfunding platforms. There's early stage. Kickstarter is different. That's not equity crowdfunding because that's product based. You're pre-selling basically. They're not getting equity. They're getting a thing that you're going to deliver to them. But with the equity crowdfunding sites, there are a lot of misconceptions. We've run a couple workshops all about crowdfunding, because there's a lot to know there. And it can seem like you're magical, like, oh, I'm going to do this, and the crowd is going to fund everything I'm doing. They're just going to come in. And it doesn't work that way. So if you're going to do a crowdfund, the successful ones start with some money in there. So you've already identified a couple angel investors, or maybe you do have friends and family, even though most don't, but you have some base where people say, okay, I'm going to put my investment through your crowdfunding campaign. So you already have something in there. And then the other element of successful crowdfunds is you have a lot of people in your community or existing customers who you've already discovered want to invest, and that they would through the crowdfund. So you leverage your network and your community more than you do people who didn't know about you before. And it's all one line on your cap table. So you don't have tons and tons of investors in this messy cap table. You do, if you get individual angels, you might have a number of them on your cap table. There's different ways you can solve for that. So there's different things, like one is called a special purpose vehicle, or an SPV. Another is called a roll-up vehicle, or an RUV, where you basically tell everyone they're going to pool, they're going to be part of this one thing on your cap table. So you have one line, just the SPV, and then they're all members of that SPV. And with a crowdfund, you could have 1,000 people participate, but it's just the crowdfund campaign on your cap table.
All right, and let's say that the investors are down, they love what they see, and they're ready to make a move. If our participants want the investors to take them seriously, do they need to be structured as a particular entity, like a C corporation based out of Delaware, and not a DBA or an LLC? Does it matter what kind of corporate entity and where they're incorporated?
Yeah, if you're going to do an equity raise, if you think that you're going to raise equity investment, you need to be a Delaware C Corp. That's what it is. So there might be some tax reasons that you want to start as an LLC or a different structure. We actually did start as an LLC at my last company, and then we had to convert into a Delaware C Corp when it was time to raise larger amounts of money. There's a number of reasons why, but really it's just that's really established regulations. Everyone knows what to expect. It is the way that investments have been done for a very long time, and investors just want you to be that corporate structure.
Right. And I have one more question for you that's coming from our audience. Again, asking if you can speak more about how you measured the success of that first client using your Google Doc, and any tips for storytelling or how to take metrics in that area would be appreciated.
Yeah. So, I mean, with that one in particular, right, my success metric, the story I tell is that we help founders understand how to present as investable, right? Our theory for our company and what I based my own first market research on was there are millions of founders out there who are investable by different capital sources. I'm actually not even focused on venture at all, who don't know how to present that way because finding that guidance and education is not affordable and accessible. So if we make it that way, they will have more success in what they're trying to do, right? So my success is my customer's success. So in order to measure that and tell the story of that, it was powerful to say, look, I just put the content and created the method of content plus specific points of feedback that helped someone get into Mass Challenge. And that customer gave me a testimonial, right? That said, I would never have gotten in if I hadn't worked with Allison and her method. So that's a proof point, right? That's when we talk about traction, that happened. And I have her proof saying that wouldn't have happened with. And we continue to measure in that way, right? We've worked with 400 founders now, and we have a software product, and we advance in our own company. I've raised an angel round for Scroobious based on early traction like that story.
Yeah, so proof of concept, testimonials, like demonstrating, that there's some, again, traction, evidence-based. So last question coming from the audience, where did you come up with the great name Scroobious?
Yes, it is a funny company name and no one quite knows how to say it. And some people think it's for Scroobious, and that was an unintended benefit of the name. But it actually comes from a poem. So for myself, when I was researching, the space and what do I want to name my company, it's a big decision. I wanted to be different. There's a lot of companies kind of in the area of fundraising and capital raising that they all sound the same. So Scroobious, there is a poet named Edward Lear. He's a 19th century poet. He was a children's poet. People know him because he wrote The Owl and the Pussycat, and There Once Was a Man from Nantucket, which are children's poetry. But he has a poem called The Scroobious Pip. It's 2 pages, and the whole thing is about a creature that enters the animal kingdom named the Scroobious Pip. And all the animals are around it trying to figure out which of them it is. Where do you belong? What type of animal are you? And at the end of the poem, they celebrate it saying, well, it's some of us and all of us, and it's unique, and it is the Scroobious Pip. That's what it is. And it was happy. So, for the founders that we work with in our mission, we should be celebrated for the unique opportunities we are and not penalized for it. And that just resonated with me.
Wow. Yeah, that's, names are important. So thank you again. What a great session. It was really awesome. If you want to learn any more about any of this, you've got Allison's info right there. Feel free to reach out to her on demand and join us for an in-person networking event and meetup. You can learn more about angel investing at our Valley Growth Lab on February 9th from 4 to 6 p.m. at the Alliance office in Sherman Oaks. It's an in-person networking event, includes some table topics, including angel investing. You can register. I think we'll put that in the link, the valley.net events/Valley Growth Lab. And if you want to take advantage of our no-cost business advisory programs, go to the valley.net/assistance. And the replay of this, the slides for all this will be available on our website. So we'll put all that in there. And thank you so much, Allison, for sharing all that knowledge. We really appreciate it.
Yeah, thanks everybody for coming and sticking around. And I just opened the chat. I'm so bad at chat when I'm presenting, and I saw there's some direct messages in there. I'm not going to see them. So if you just email me or reach out to me on LinkedIn or something, and please, I will answer you if you go that route. I didn't get a chance to, obviously, today.
All right. Yeah. Please write her directly. So my colleague Erica is on the line. I'd like to introduce Erica. And she's going to provide the name of the winner of the drawing So without further ado, pass it over to you, Erica.
Oh, thanks, Brett. So I set up a formula through the attendance. So it will randomly select a name, and it's Bhatia, Sbhatia. I'm sorry if I don't pronounce your name correctly.
Let's
So
see,
let's
are they
she's
still
present?
is
Are
that
you
anybody?
here? Yeah.
Yeah, can you hear me?
Congratulations. Yes. You are the winner of the $100 gift certificate.
I appreciate that. Lucky day. What
Lucky
do I
you.
do to retrieve that?
So let me make sure we have your information when you registered. I need your, I have your email address, so I will email you so that you send me your mailing address so we can get that over to you. Okay, congratulations.
All right, yeah,
And
congrats.
thank you again, Allison, for supporting us and providing that gift certificate.
All right. We look forward to connecting with everyone soon. Erica, you could feel free to stop the recording.